Hi everybody, and welcome back to Fang Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management. Before I start, thanks to everyone who likes this video and all our subscribers. I appreciate your help with the YouTube algorithm. Anyway, the FANGs. They kind of settled down into a sort of dull roar. Monday the 8th, that's COVID-19 vaccine day, was a new day. And as I said, you may well need to look at all of your own holdings in that light right now. Well, since then, the FANGs have at best treaded water, as the market leadership has changed towards the so-called value stocks. The question is, are the FANGs getting set to make an assault on new highs, or is that story more or less over for now? Today, we'll take a look and see what they may be trying to tell us right now. As I did last week, I will continue to look at the FANGs from 3 points of view. First, if I owned the stocks, what would I do now? And second, if I was thinking of getting in, should I? And third, if I do, where would my target entry point be? So let's take a look. Today, I am going to leave the fair market value lines on the charts. I usually take them out as I sort of scrunch the structural valuation lines together. But today I really want to provide a sort of an aerial overview rather than a close-in picture. So let's start with Amazon. The first thing, of course, that might stand out if you're looking at the fair market value is, this is, by the way, the dotted line. It is, at the present time, 75% below the current price. This is not exactly what you would call a discounted value stock, is it? Now, our last shot at Amazon occurred the day before the election. Remember that little sell-off that happened? And I said at the time, on the sell-off day on the Monday, I would purchase the stock if it had a decline, and it did. Didn't quite get to our structural valuation line, that is the HB3, but came pretty close. And from a portfolio point of view, I would therefore say, look, I'm in right now. Apple, well, again, effectively, I am in Apple. You will remember that when the stock got up here to this peak here in the 2nd of September, okay, it was trading right at its then HB5 price. That's 26 times book value. And then, of course, and it hit a perfect hit, and then it set back perfectly down to its HB4 price, which is 20 times book value. Well, you don't see that anymore because there has been a new balance sheet come in, and that has changed the structural prices quite considerably. What happens in these cases is that the stock begins to kind of readjust, and it takes the new breakpoints to heart, as it were. And of course, that's what happened here. The stock got up to its HB5 price, you can see there, didn't make it through, and it's been setting back ever since. However, our entry point here was HB4, and that would be about $103, $105. So I would be willing to stay with Apple right now, as because if it fell down to that level, I would get a perfect buy signal, and until that time, I'm on side as far as the stock is concerned. Nvidia, well, we had a buy signal on the stock. We had such a fast run up and then such a catastrophic drop down in 2 days that effectively, I was kind of stuck in the stock, if you like, from a portfolio point of view. Now, when you look at the subsequent action of that company, however, you see it's kind of trading a little sloppily on either side of its breakpoint. And I have warned you before that sloppy trading is very often a signal that the market is unsure of what it's going to do with the company, and very often it has led to downside risk. So I'm very cognizant of this. I don't have yet a clear sell signal on the stock, but I am kind of nervous here. Now, the other reason, of course, that makes me concerned is look where the fair market value is, 67% below the current price. So again, this does not come under the heading of value stock, does it? Facebook, well, we had a perfect sell signal at its bubble price. That's a 7.4 times book value. And that, of course, was the peak of the stock in 2017 as well. Subsequent to that time, it is set back, but it didn't get down to its mid-super growth price. That's 5.5 times book value, an important support level. And subsequent to that time, it has been kind of drifting in between those two levels. Now, when the stock got down here and we were reviewing it, I said, look, I would have sold here, but what if you hadn't sold and you were still in the stock? Would you still sell down here? And I said, well, probably not. It's close enough to support that I would probably keep on holding it. The problem with stocks that trade like this, however, between breakpoints is that they are essentially trading as random walk. Okay, it is only at the major breakpoints that we actually get a signal as to what to do. If I did not hold the stock, I would be perfectly happy not to hold it. I had a good sell on the stock. If I held the stock, I'd probably hope that the mid-super growth price holds for now. Anyway, those first three stocks were the buys in what I might call in my phantom Fang portfolio. Facebook, a question, and now we look at the stocks that I do not like. The first one is Alphabet. And Alphabet had a beautiful move right up to the top of its 10-year channel. And at that point, I said, let's sell the stock. If I take a much closer look at the company, however, I can see a couple of things. First off, remember back in September, the stock got very close to that level. Of course, we had Facebook as a sell and a couple of other companies. So I had said, look, historically, the stock has actually never got to its MSG price. I would take my money off the table. And indeed, it had a very nice setback to the low super growth price. That's 4.5 times book value. At that point, however, given the fact that we have no sell as far as the market is concerned, I said, look, I would simply take my heart in my hand and buy it. And that has worked out very nicely because the stock has moved right back to its, actually to its mid-super growth price this time. Of some interest is the fact that when you look at the fair market value line, it has this nice upwards kink there. So perhaps giving as earnings revisions come in to the upside and a bit faster, perhaps giving a bit of impetus to the stock to go a little bit further than it might otherwise go. However, for now, it's a sell. The same thing with Netflix. I mean, this is what I call sloppy trading par excellence. And it is not a stock that I would choose to hold. Now, if you take a close look at the company, or at the stock actually, from sort of the market technician's view, you get a kind of a different story than you get from an SVA point of view. I hope you can see that very faint dotted line there, because what you see here is that the company is sort of flatlining, as it were, and it's forming a nice channel there, a nice parallel channel. So I will be watching this thing very carefully to see if it manages to hold. I kind of expect that it will drop out, but nonetheless, I do not like the stock, and I'm concerned about the competition coming down the road. Finally, Microsoft, again, very sloppy trading, and broadly speaking, I wouldn't necessarily choose to hold this company until I get a clear buy signal. Okay, in summary, the market appears to be moving on from the growth momentum phase to a value approach to stock selection. The FANG fair market value targets are miles below their current prices, as I think you saw. And any concerted swing to value investing would be likely to exclude most, if not all, of these stocks. Please note that this does not mean that I think their growth stories are over and done. A few weeks ago, I showed you what the demise of Coca-Cola looked like as it fell for being an extremely priced stock in the 2000-2002 meltdown. Even as the price to book valuation fell from its HB5 or 26 times book value to its super growth price, that is SG price, of 3.5 times book value, the earnings and the sales never missed a beat. By the way, do you recall what I also said about such stocks? On the way down, they offer terrific trading opportunities, so bear markets need not necessarily be run and hide markets. In what I call my Fang portfolio, first and foremost, I would own Amazon following our buy on Monday, November the 2nd. I would hold it as it is holding above my entry point, which is just at or just above the HB3 price. I still don't see any follow-through. If I was thinking of buying, it's a time to be patient. I would wait for the HB3, but I would also be aware that the HB3 price must hold, or the market will be warning that there is further downside to come. Apple would be my second holding. The last SVA signal was a buy at the old HB4, which you can't see anymore due to share buybacks. I would not be as comfortable as I was when I bought it. And if I was looking to buy, I think I would wait for a clear signal, either a setback now to the HB4 price, which of course was the level that we originally got in a few weeks ago, or would break out over the HB5. Otherwise, I would do nothing right now. My third holding would be NVIDIA. I would not necessarily love the stock, as it increasingly looks as if what I call sloppy trading is taking place, often a warning of market uncertainty and therefore lower prices ahead. If I were looking to enter the stock, now is as good or bad a time as any, but I would be watching that HB4 price, that's 20 times book, to make sure that we don't get a sell signal. By the way, we had been waiting for the new balance sheet, but it's in our chart now. No major change occurred, as our algorithms had actually picked up the forecast and the expected change with precision. There is one stock in limbo, Facebook. It's in limbo because we had a sell on the stock, and by the way, I still wouldn't own it. However, in late September, when the stock had really set back, I did observe that if I owned it and had not sold when it hit its sell signal, I would hold. So if you were measuring my Fang portfolio performance, as it were, you could put it in or take it out, depending on your mood that day. The stocks that I personally would not own, Alphabet. Well, it hit its 10-year valuation high, hasn't broken out. which is hardly surprising when you look at the SVA chart. If it can break out over the mid-super growth price, that's 5.5 times book, I would buy it back. I doubt it, but never say never. Microsoft, if I held, I would probably continue to do so somewhat nervously, remembering that SVA regards stocks that trade like this as being sloppy traders, and such action is often followed by downside risk. If I was thinking of buying, however, that's another story. I would need a clean breakout over that HB2 level. And a check back there, sort of the technician's breakout pullback, and it would have to hold. Still, as I said last week, on the whole, I'd rather be in Philadelphia. Netflix is a real COVID-19 stock, but I see sloppy trading, which often leads to lower prices. I personally would still probably sell. But with the COVID-19 reprise, there is some reason to hang in and hope. If I was looking to enter the stock, I would definitely wait for a decline to the HB3 and hope for a rebound. Now, last week I observed that a number of our Fang Friday subscribers are interested in our service all right, but they want to look at my detailed video conference webinar first before they would consider signing up. Well, we heard you. And on January the 6th, I will do the same general webinar that I do with all new subscribers to the SVA service, but it will be open to all. Now, obviously, with a number of viewers, it cannot be personalized with your own portfolio holdings as I do with our SVA clients, of course. But it will be every bit as detailed. So if you're interested, please put your email address in the comment section below, and we will sign you in for it. Anyway, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools, as I trust we have been very clearly showing you. I'll see you next week.